Hello everyone, welcome to PE Wealth. In this modern world, the majority of the youth are so fascinated by one typical industry, that is capital market, or in simple words stock market, share bazaar, right? If you try to look your surroundings, you may easily find such peoples that are actually whispering something or a little bit about the stock market. Well, nowadays, it doesn't matter in which profession a person is in. They usually discuss and try to conversate on the hot topic stock market. Today in this short article, we are going to explain stock market jargon that you must know. So first, stock split. Well, stock splits are a corporate action in which a company divides its existing outstanding shares into multiple smaller shares. Let's understand with an example. If you are an active participant in the stock market, you may have noticed that recently in the month of July 2022, Tata Steel announced the stock split in the ratio of 10:1. So, for the investors and shareholders, what does it mean? Well, this means that now Tata Steel will split its stock price from 1000 rupees to 100 rupees for a single quantity. In other words, shareholders who were owing a single share of Tata Steel of 1000 rupees will convert into 10 shares of 100 rupees each. Here, the investment value won't affect it, but the returns may affect either positively or negatively because of cheaper price and better liquidity. Keynote: if any stock splits, there are more chances that retailers will now invest more, which will rise company market capitalization. Second, bonus shares. The easiest way of understanding bonus shares is understanding it as a surprise from the company. Why the surprise? Because surprise is given free of cost by your loved ones to make you happy. However, if you are looking for a proper definition, bonus shares are additional shares provided to shareholders without any additional cost. Usually, companies issue additional shares to shareholders instead of delivering dividends. Have you ever thought about it? Why do companies issue bonus shares? Well, the companies issue bonus shares to settle the reserve and surplus or capitalizing accumulated profits from their balance sheet. A wise tip: generally, the companies issue bonus shares in multiples. Example: 10:5, 20:10 and 100:50. So if you don't have enough shares, then you won't be eligible. To take advantage of bonus shares, make sure you have enough shares on the day the announcement was made. Upon an issue of bonus shares, the dividend per share decreases as there is an increase in the number of shares. Third, buyback. Buyback is another popular term that sounds many times by different companies at different intervals. A buyback is typically corporate action, approved by the board members of the company. Usually, when a company has adequate cash in books but doesn't find any investment opportunity, or when the company finds its share price undervalued, so the company purchases some proportion of its shares from the existing shareholders. In simple words, this purchasing of its own shares from the shareholders is known as the buyback of shares. Generally, it assumed when a company announces a buyback of shares, it delivers a healthy sign to investors, as the investors carry this action as strong faith and trust in the company's long-term perspective. Companies do two ways of buyback shares. First is from open market route and second is from offer tender route. Let's have a more detailed explanation. If a company offers buyback shares at a specific price, then shareholders will have the opportunity to receive the difference, which is a premium, fortunately, a type of gain. Tip: a company that offers to buy back shares for a higher price than the current market price, selling of own shares should be avoided, since it is likely that the value of a share will increase soon. Now let's know about the dividends. If you are not a short-term trader or positional trader and tend to hold stocks for more than a year, you must have received a notification in your bank from your holding company. Well, this is another gift that a usually company provides to its shareholders. When you buy the stock of a company, you become a part owner of the company. You are a part of the prosperous future the company wishes to build for itself. Hence, you also entitled to receive whatever profits it decides to redistribute as a reward for believing in its business and investing in it. This reward is termed as a dividend. In the simplest term, when a company settles its total profits after adjusting all expense, and whatever the amounts are left, it becomes extra profits and distributed among shareholders. A wise tip: an investor should look for high growth stocks instead of dividend paying stocks, because a company that doesn't pay dividends can be considered more solidified and vigorous. They tend to deliver more returns in comparison to fixed dividends. That's it for today. Check out our blog section for more meaningful in-depth insights. Link in the description box. Like our video if you find anything valuable, and comment if you have any query.